You're listening to the UAE's #1 talk radio station.
This is the Business Breakfast on Dubai Eye 103.8.
With Richard Dean, Brandy Scott and Tom Urquhart.
Yeah, it's not just direction of travel, but also the pace at which we are moving. That comes out strongly in the latest report from Property Monitor. It's going to be released a little bit later on. As always, we have a sneak preview. As always, there's another record in it. We are very pleased this morning to be joined by Zan Jahinki, who is the COO of Property Monitor, as well as the Director of Market Intelligence and Research at Cavendish Maxwell. Zan, good morning. It's lovely to see you.
Good morning, likewise.
I'm less interested in the record this month and more at the pace at which prices are appreciating. Am I wrong?
You are right.
Good.
The records are just getting like a broken record, like you said before. We keep hearing about them, but the pace has picked up. It's doubled. So we look at our monthly price index, and pretty much throughout the year, we started out with really modest price growth under 1%, started to tick up into the low, mid 1% range. Now we've jumped up to almost 2.5%, 2.48% month on month. That's a pretty big jump, and it's territory that I don't necessarily like to see us in. It's the second highest month-on-month appreciation we've had in this entire market recovery cycle. The other one was 2.51, just slightly above that occurred twice in the last sort of 46-month period. So we've had this jump up. What's driving it? So you have to look at, this is an index as the whole that covers Dubai. So it includes 42 communities, and it's like an index, it's a basket we try and keep relatively stable. There are a lot of new launches happening, which is also, sounds like a broken record every time we're talking. Those launches are selling, those sales are being recorded, and they are being recorded all throughout Dubai. When they come in somewhere like downtown Business Bay, which historically has had a healthy mix of ready properties and new launches happening, there's not as big an impact. Those communities are still going up month on month. But when you take somewhere that historically hasn't, somewhere that's really being re-energized now is Motor City, where you've got 3-4 launches that happened in the last couple of months there, those price per square foot are significantly higher than the ready properties that are trading there. So in some of those communities, they're jumping up significantly month on month, which drives the overall index up proportionately to some of those areas.
Okay. I'm going to stop you there. Let's dig into some of that. I'm going to start with something you said a few minutes ago. Why don't you like it?
It's not sustainable, right? Let's extrapolate that out. If it continues, 2.5%, 3%, that's going to get us at 25 to 30% year-on-year price growth. Can anyone afford to buy a property at a 30% increase in a year's time? It's going to start pricing more and more people out, even those that are well-financed. It's also going to put you at somewhere where you're going to have, even with rents high, your return on investment is probably going to, those ROIs are not going to line up where you want them to be. The last market cycle is what I'll refer back to, right? We saw price growth hitting the mid-twos pretty consecutively month on month, and the government acted. They put measures in place to slow down and to avoid us going towards a bubble. Those measures were doubling the transfer fee, which I'm sure no one wants to see it go from 4 to 8 right now, and putting in changes to LTVs. Right? Those were two things the government did to slow down that market. It only went 24 months up and then started to plateau, and then we had a 6-year downturn that was driven by multiple factors. I don't want to see us going that same way where we go towards bubble. Right now, I don't think we're near bubble territory. We're in an appreciating market that has gotten there rather modestly, and it's done it with a mix of ready sales in the beginning, completed properties, having the initial growth, and then off-plan coming in. Now we're getting to the point where off-plan is truly dominating the market. Over 70% of sales last month were off-plan.
Okay. This is 1 month that we've seen this, though. What if it's a blip? I mean, why August have we seen this now?
So it's really to do with those launches and when they've been coming on. The lag from when a project launches to when they're actually recorded used to be longer. Now you're seeing if email launches something on the 1st, you're getting transactions that month coming in. So it's within 30 days. Technically, the developer has 60 days to get those in. Most developers we're seeing with those proper launches come in that first 2-month period. Some have exceptions for longer or have expression of interest, but you're seeing them come in. So is it going to be a blip? Maybe it's going to be the high point of the blip, but next month I still wouldn't be surprised if we see it in the 2s. Maybe it tapers off a little bit. Knowing what has launched in the last 3 months gives us an idea of where prices are going to be in the coming 3 months. So it will be still high. I don't think it will drop down to 1%. If we continue to see launches go higher and higher in price per square foot every time a new project launch, it's obviously going to drive up. The completed market, though, is, for most people, going to be happy to hear this, it's relatively plateauing in a lot of communities, especially villas and townhouses. Unless something is being bought and then significantly renovated, they're not trading at a big premium over the last couple of sales. They're trading at a couple of thousand more, a couple of 100,000, but not 5, 10, 20% more.
Okay, so you say that in the last cycle, when we hit this pace of appreciation, this is the point that the government stepped in with those measures. Where was it in the cycle, though? Did it start to herald the end of it?
So it actually was happening throughout most of the cycle. It was a big fat chunk in the middle where it was just consecutive. Month on month, you saw it in the twos, high twos, almost pushing 3%. Yeah. That's why I think action was taken, because it was going up so fast. If we see it continue like this, 2%, 2.5% for, say, 2 quarters, 6 months worth, I would be really getting nervous. And I think we would see that would be the canary start singing. Things are happening. Prices are going up too quick.
Canary starts singing it's the end of the cycle. Canary starts singing there might be intervention.
Both. I think where you're going to see this cycle change, right? Everything's going to be driven by supply. Oversupply is what pretty much drives every market around the world to go into the downward phases. It will happen first in off-plan, and it will happen because there's just too many properties out there and not enough buyers. Investors will look to diversify. Maybe they don't want more than 10 properties to buy and they want to buy something in another market. They will diversify and it just won't be absorbed. So one of the first things to see, and it's what developers I work with really track, is they're going, what's absorption happening? If I launch a project and we're selling it out 90% of it within 30 days, they're pretty happy. If it takes 60 days, fine. Small developers, less known ones will always take longer. If the big boys start taking longer to sell a project, it's going to be one of the first warning signs. And that's when you'll see them throw concessions, incentives, and everything out. They'll pay brokers more commissions. They'll give away cars and Rolexes and all those bells and whistles that are just in the purchase price to begin with.
I've got 1 minute left with you. What are you hearing about how long it's taking developers to sell those off-plan properties at the moment?
Some are going, when you hear that it sells out at launch week. An EMAR project will largely sell out, and let's just say 90%, we'll call it 90%, is roughly sold out. They're getting that at launch. Demac selling some stuff out in a couple of days. Some of the bigger developers, really good traction. That balance 10%, sometimes it's by design. They want to keep a few units, or they've had some bookings and they come back. So in a typical project, we're seeing, and we track the sales come in, about 3 to 4 months to have all the registrations in, which means they probably sold out within the first month. Small developers taking upwards of 6. So when we start to see that shift by, say, EMAR doubles from 30 to 60 or to 90, that will be one of those signs that we're seeing a slowdown, not a crash. And I think that's the big thing to look at. We are probably going to go into a slowdown of the market driven by an oversupply and off-plan.
Sandra Henke is the CEO of Property Monitor, Director of Market Intelligence and Research at Cavendish Maxwell. Maybe a canary. Thanks very much for your time this morning.